Hello and welcome back to another video. Today we're talking about the buy, refurbish, rent, refinance strategy, the BRRR strategy. Now there are lots of different variants on this. You could have 2 Rs, 3 Rs, 4 Rs, and I'm going to come on to talk a little bit about this strategy and there are different options available. Make sure you stay tuned to the very end of this video because what we're talking about when it's best to use this strategy, the pros and the cons, and we're going to go through an example. And I've saved some mistakes towards the very end that I see property investors, the mistakes they're making undergoing this particular strategy. So for those of you that don't know me, my name is Marco. I'm a property investor, developer and mentor. I'm a portfolio landlord and I love to help people invest in property, whether they're completely new to property or maybe they have 1, 2, 3 properties and looking to scale to that next step. So today we're talking about buy, refurbish, rent and refinance. So first of all, let's actually define what this strategy is. So the BRRR strategy, what is it? Well, first of all, it's where we're buying a property. Next, we're refurbishing the property. So we're doing some works to it and adding value. After it's been refurbed, then we're renting it out. And once it's being rented out, then we can refinance the property. So buy, rent, refurbish, refinance. Now you can do a few of those in slightly different order. So for example, you could actually refinance before you rent it out. And again, some people like to add another R onto the end to repeat it. So buy, refurbish, rent, refinance, repeat, because once you've refinanced, you can pull your cash out and repeat this into the next deal. And again, we're going to talk about that later on in the video. So that's what it is. It's a very simple strategy. And once you've watched this video all the way to the end, you'll thoroughly understand the BRRR strategy. Well, first of all, let's come on to why use this strategy. Well, the number one reason why investors like to undergo this strategy is normally it allows you to take a significant chunk of your cash out at the end of the deal. And let me go over the numbers to show you an example. So let's say we bought a property for £100,000 and we say we're doing a full renovation, maybe we're spending £25,000 completely refurbing the property. So we're all in for £125,000. Now we rented out the property. Now in this particular example, we're not going to talk about the rent. I just want to illustrate the fact that how much cash you could potentially pull out. So we've rented out the property, great. So when it comes to refinancing or actually financing it in the first instance, there are several options. So one option is you're buying the property with cash. Then once you've refurbed it, you're financing the property. So you're getting a mortgage on the property. Some lenders insist that you wait at least 6 months from purchasing the property to financing it. Now, there are some lenders that are willing to ignore the 6-month rule and they will refinance and they will finance your properties in less than 6 months. You normally pay a slight premium for these lenders. The other option you've got is, let's say you purchase the property with a mortgage in the first instance and you want to move from your original purchase mortgage to a remortgage on the new higher valuation. Well, then, again, you can refinance either early and pay your early repayment charges if there are any. The other option is to wait until your fixed term has expired. So maybe waiting 2 or 5 years to refinance the property to pull that cash out at the higher valuation. So you've got lots of options when it comes to financing and refinancing. So it's really crucially important that you structure this acquisition properly. And this is what we're going to come on to at the very end of the video. And we're going to be talking about the mistakes that I see property investors making time and time again in this particular strategy. So going back to the original question, which is why do investors undergo and undertake this particular strategy? It's because they can pull their cash out and they're trying to pull as much as cash out as possible. So let's go back to our original example. We're all in for about £125,000. Well, if this property is now say worth £160,000, we've put £25,000 in, we've bought it at a really good price anyway, and this is now worth £160,000 once it's done to a good standard. Well, we can get a new mortgage on that new higher valuation of £160,000. Now let's make the maths nice and easy. Let's say we're getting a 75% mortgage, our new mortgage, on £160,000. So the new mortgage is £120,000. So let's go over the figures now. So we've actually all in this property we're £125,000, but we get a new mortgage for £120,000. So let's just say, make the maths nice and easy. You paid cash for this particular property and you're all in for £125,000. Well, all of a sudden the mortgage lender is giving you £120,000. So you only have £5,000 of your own cash left in that property, which is absolutely great. So the reason why people do this and investors undergo this strategy is because they can get that money from the bank, get that new mortgage, that £120,000 from the bank, and invest that into the next deal. And this is where the final R, repeat, comes in the BRRR strategy. So they can repeat the process because they've now got £120,000 to invest in the next deal. So that's a really nice, easy example if you're buying cash. However, if you're buying with a mortgage from the onset, this gets even better because, so if we go over to the figures again, and let's say we only put in a 25% deposit to acquire this property at £100,000, well, that's only £25,000, right? £25,000. We've also spent another £25,000 refurbing the property. So we're all in for £50,000 plus fees, let's just call it £55,000. So that's how much cash we've got, our own cash in this deal. Now, again, once we've got this property valued at the new higher rate, £160,000, let's assume that's the market rate for a nicely done property in that area. Again, we're asking for 75% of that value, which remains the same, £120,000. So that's the new mortgage we're taking out. Now, our old mortgage is 75% of £100,000, which is £75,000. So in this particular example, we are taking our new mortgage, which is £120,000, paying back our old mortgage, which is £75,000, and that gives us a £45,000 cash in our account, which is absolutely crazy. Now, again, we've got £55,000 of our own cash in this deal. So once you've got that 55 minus the 45 we've got from the bank in the cash surplus, we've only got £10,000 of our own cash left in this deal, which is absolutely phenomenal. Now, some people like to maximize this to the nth degree and get all their cash out. So, in the example I've just illustrated, maybe they would only opt for this strategy if they can get an end value of, say, £170,000, where all their cash would be out the deal. However, in my opinion and my personal advice is don't be obsessed about getting all your cash out the deal. If you've only got £5,000-10,000 of your own cash left in the deal, it's still going to be an incredible return on investment when you look at it from a return on capital employed basis. So the number one reason, just to recap, why investors undergo this strategy is to pull their cash out in the short term. So, normally within 12 months or 24 months. And again, for that cash to be reinvested in finding the next deal. And you can repeat this process. And over a number of years, you can amass a quite sizable property portfolio, just repeating this buy, refurbish, rent, refinance, repeat strategy. So that's how it works. And we've gone through two examples. We've gone through, buying with cash in the first instance, but also then buying with a mortgage. And they're both great ways to undergo this particular strategy. You don't need to be buying properties in cash for this strategy to work. You can quite simply be buying with a mortgage from the onset and again refinancing at a higher valuation. So the biggest mistake I see with this strategy in terms of the refinancing side, so the penultimate R, the refinance R of the strategy, is that I see investors not telling their broker, their mortgage broker, the truth from the onset. Now, the saying in property is you should tell your mortgage broker all your secrets, but keep them from your solicitor. So when you're telling your broker your ideas around this strategy, your broker needs to ensure they're finding the best possible mortgage to suit your needs. And what I mean here is if you plan to refinance this property within 12 months, well, most of the time, if you've got a fixed mortgage in the first instance, you have to pay early repayment charges to exit that mortgage. If you don't tell your mortgage broker the truth, they're not going to be considering the ERCs, the early repayment charges, that much when they're looking for a mortgage for you. And all of a sudden, they could recommend you a mortgage that has really high early repayment charges. And guess what? If you want to refinance early and break your fixed term mortgage, then you've got to pay those really high fees. So this is why you've got to tell your broker the honest truth. Tell your broker what you're looking for, what you're looking to do with this property. Tell your broker that within 12 months, I'm looking to actually refinance and go from a mortgage A to mortgage B. So therefore, can we have a look at rates, but also look at ERCs? And once we combine these fees together, we need to find the lowest cost that will allow us to switch from mortgage 1 to mortgage 2 after 12 months, for example. So that's one of the biggest mistakes I see with this particular strategy. The second bigger mistake I see, and I already mentioned this mistake in a previous video, my 10 biggest property investor mistakes. If you haven't already watched it, it's a great video. And once you've watched this video all the way to the very end, here's a picture of the thumbnail. The link is in the description. Please do watch the video. The second biggest mistake is I see investors undergoing this strategy and overestimating the final done-up end value of the property post refurbishment. And again, this is a real serious issue because if you overestimate this valuation and you don't get it, all of a sudden it minimizes the cash that's going to come back to you as an investor at the end of the deal. Because when the valuer goes out and says, sorry, I don't agree with your £160,000 valuation, I'm actually going to value it at £145,000, well, all of a sudden that's a far less cash that you were expecting coming your way after the refinance. So it's important that you're realistic with your end valuations. Don't push them too much. If anything, be a little conservative. You'd much rather be surprised with a higher valuation than have to worry about maybe paying back investors or paying off the original mortgage with a lower valuation. And there's lots of ways we can accurately value property. Again, you can look at sold prices, and again, we want to be using comparable properties, so ideally properties that are very close to that property that you've purchased, maybe on the same street, for example, a same property type, so are they also 2 and 3 bed properties, or are they semis, are they detached, are they terrace, what are they? And again, we want recent sales. We don't want sales that are 10, 20 years ago. We want sales that are maybe 1, 2 years ago. Again, another way of doing this is to have a look at the square footage and multiply that by the average residential value in that area, and that will give you another good ballpark of what that property may be worth post refurbishment. So the third mistake I see investors making with this particular strategy is when they come to refurbing the property, they don't do a proper refurb. Now, what do I mean here? Well, maybe they're doing it on the cheap. Instead of spending £25,000 on a proper full refurb for a 2 or 3 bed house, say for example, they're spending £15,000 and not doing the full thing. Well, the problem you've got there is, I understand you're putting less cash in, I fully appreciate that, but when the valuer knocks on the door to come value the property, they're not going to value that property right up here at, say, that, for example, that £160,000, £140,000, because you haven't really invested as much as what you should have in increasing the value of that property. So if you're undergoing this particular property strategy, make sure you do it right. Invest the capital required to bring up the level and the value of that property to what it should be. And the fourth and the final mistake I see investors making with this particular strategy is not buying at the right price. So paying too much for a property. The money you make in property is all to do with the price for which you purchase that property for. And I'll repeat that again. The money you make in property is absolutely all about the price you pay for the property. So, I see investors time and time again paying too much money for a property. And what this means for people and investors undergoing the buy, refurbish, rent, refinance strategy is minimizes the equity left in the property. So, for example, let's say we're buying property for £100,000, but actually, if we could buy that for £90,000, which is obviously a £10,000 difference, we've got an additional £10,000 equity in that property from day one. So by getting a good below market value offer accepted on a property, it gives you pre-refurbishment equity in the property, which is absolutely incredible. This means you're not relying solely on the renovation of this property and the refurbishment of this property to increase the value and make this strategy work. You'll have a double whammy. You're making money from day one of owning this property just because you bought it below market value, and also you're adding value via refurbishment. And this is a great way to increase your margin of safety, decrease the risk, and therefore increase the equity and the profitability and the cash flow at the end of the day for this particular strategy. So that concludes the video. We've discussed what the buy, refurbish, rent, refinance, repeat strategy is, why it's best for investors to undergo this strategy, the process and how it works, and we've gone over a few examples: buying in cash, buying in mortgages, and how the refinancing part of this strategy works, which obviously is the most important part of this strategy. It allows us to withdraw cash, use that cash to go again and repeat the process. If you're still struggling to understand the buy, refurbish, rent, refinance, repeat strategy, and you're looking for a bit of help, head to my website www.ms7.uk and book a call with me. You can click on the coaching and mentoring service, and I'm more than happy to take you through this strategy and tell you from start to finish how you can make this strategy work for you. Thank you very much for watching the video, and I wish you all the very best with your property investing day. Goodbye.